Something just broke in the global financial system, and I'm not talking about the price on your screen. Ladies and gentlemen, Asian guy here. At exactly 4:17 a.m. Eastern Time this morning, the Federal Reserve Bank of New York executed an emergency liquidity injection of $34 billion. $34 billion into the overnight repo facility. On the same morning that silver hit $85 in Shanghai. The timing isn't a coincidence, but here's what makes this morning different from every other crisis intervention you've witnessed. This wasn't scheduled. This wasn't part of some routine operation. The Fed's repo calendar showed zero planned injections for this week. Zero. The markets were supposed to be quiet. The holiday week was supposed to be peaceful. Instead, at 4:17 a.m., alarms started ringing in the Federal Reserve Building. Emergency protocols activated, senior officials were called out of bed, and $34 billion materialized out of thin air. Let me show you what they don't want you to see. While you were sleeping, while the Western markets were closed, the Shanghai Futures Exchange printed a number that should terrify every central banker on the planet. $85 per ounce. But here's what makes this price dangerous. Here's what makes this different from every other rally you've seen. The price in New York is $71. Think about that for a moment. The same asset, the same silver, trading at two completely different prices on the same planet. $14 apart. That's not a spread. That's a divorce. But the $14 gap is just the surface. When you dig deeper into the Shanghai data, when you look at the actual transaction volumes, you see something that should make every trader's blood run cold. The buying isn't coming from speculators. It isn't coming from hedge funds chasing momentum. The buying is coming from industrial accounts. Massive industrial accounts. We're talking about solar panel manufacturers placing orders for 50 million ounces. Battery companies securing quarterly supplies of 30 million ounces. Electronics giants stockpiling like they're preparing for a siege. These companies are looking at their production schedules for next year and they're terrified. They're not buying silver at $85 because they think it's cheap. They're buying it at $85 because they think it's the last time they'll be able to get it at any price. Let me give you the specific intelligence we're receiving from the ground level in Shanghai. The buy orders aren't coming in during normal business hours. They're coming in at 3 a.m., 4 a.m., 5 a.m. Industrial purchasing managers are waking up in the middle of the night to place emergency orders. These aren't planned purchases. These aren't budgeted acquisitions. These are panic moves by companies who have suddenly realized that their entire business model depends on a metal they can't guarantee they'll be able to source. One solar manufacturer in Jiangsu province placed an order for 80 million ounces yesterday. 80 million. That's enough silver to build 500,000 solar panels. They're not planning to build 500,000 panels next month. They're planning to build them over the next 3 years, but they're buying 3 years' worth of supply right now. Today, at whatever price Shanghai demands. Why? Because their supply chain managers ran the numbers and realized that if the current shortage continues, if the Western vaults stay empty, if the arbitrage stays broken, there might not be any silver available at any price by the middle of next year. In a functioning market, this gap should not exist. Arbitrage traders should be buying every ounce in New York for 71 and selling it in Shanghai for 85. Risk-free $14 profit. But they're not. Why aren't they? Because they can't. The bridge is broken. The mechanism that keeps global prices unified has snapped, and when arbitrage dies, something much darker takes its place. Panic. But let me tell you exactly why the arbitrage is dead. It's not just about logistics. It's not just about shipping costs or insurance premiums. The arbitrage is dead because the Western banks don't have the metal to ship. I've been tracking the COMEX warehouse reports. The registered silver, the metal that's actually available for delivery, has been bleeding for months. We started the year with over 40 million ounces in registered inventory. As of yesterday's close, we're down to 18 million ounces. And falling. 18 million ounces sounds like a lot until you realize that's less than 3 days of global industrial consumption. 3 days. The COMEX is running on fumes, and the industrial buyers in Shanghai know it. They're not just buying silver at $85. They're buying silver at $85 because they know that in 3 months there won't be any silver left to buy at any price. They're not making a market bet. They're making a survival bet. The Federal Reserve didn't print $34 billion because the economy is strong. They didn't flood the system with liquidity because everything is running smoothly. They printed that money because somewhere in the bowels of the banking system, a margin call just arrived that they couldn't ignore. Here's what happened in the dark hours before dawn. The Shanghai market opened with silver gapping up to 85. Within minutes, the clearinghouses in New York started calculating, started running the numbers on every short position, every derivative, every paper promise tied to that metal. The computers spit out a number, a very large number, bigger than the banks had in their checking accounts. But let me walk you through the exact mechanics of this crisis. When silver jumped from 71 to 85 overnight, that's a $14 move. Sounds manageable, right? Wrong. In the world of leveraged derivatives, that $14 move created losses that cascade through the entire system. Every futures contract represents 5,000 ounces of silver. A single $14 move means $70,000 in losses per contract. Now multiply that by the hundreds of thousands of short contracts that the major banks are holding. We're talking about losses in the tens of billions. But it gets worse. These banks don't just hold the contracts. They've used these contracts as collateral for other trades. Interest rate swaps, currency derivatives, bond positions. When the silver contracts lose value, the entire daisy chain of leverage starts to unravel. The margin calls weren't just coming from the COMEX. They were coming from every major clearinghouse on the planet. London, Tokyo, Hong Kong, all at the same time. All demanding cash. Right now. So they called the Fed, not with a request, with a demand. $34 billion right now. Or we liquidate everything and silver goes to 150 before lunch. The Fed had a choice. Let the free market work. Let the shorts get squeezed into bankruptcy. Let silver find its true price. Or print the money, save the banks, and hope nobody noticed. They chose to print. But here's where this gets terrifying. The $34 billion wasn't just written into existence and handed over like some routine transaction. Emergency protocols were activated. The Fed's crisis management team was assembled in the middle of the night. Senior officials who haven't been called out of bed since March 2020 were suddenly making decisions about the stability of the global financial system. And they had to make those decisions in minutes. Not hours, not days. Minutes. Because the Asian markets don't wait for American bureaucracy. Every second that passed while the Fed debated was another second that silver could gap higher in Shanghai. Another second that the losses could multiply. Another second closer to total systemic collapse. The speed of this intervention tells you everything you need to know about how close we came to something catastrophic. When the Federal Reserve moves that fast, when they bypass normal procedures and inject that much liquidity without a committee meeting or a press release, it means the alternative was unthinkable. But here's the problem with trying to put out a fire with gasoline. That $34 billion doesn't make silver cheaper. It makes dollars worth less. Every new dollar printed pushes the purchasing power down, and when purchasing power falls, hard assets rise. The Federal Reserve just guaranteed that silver goes higher. They're trapped in a feedback loop of their own creation. The more they print to save the shorts, the more the shorts need saving. The more the shorts need saving, the more they have to print. It's a death spiral disguised as a rescue operation, and the market knows it. Look at the volume in Shanghai. Look at the desperation in those buy orders. These aren't speculators chasing momentum. These are industrial users, solar panel manufacturers, electronics companies, battery makers. They're looking at that $14 gap, and they're doing the math. If silver is 85 in Shanghai and 71 in New York, and the bridge between them is broken, where do you think they're going to buy? They're going to drain New York dry. They're going to take every bar, every coin, every ounce they can get their hands on at the discount price. The COMEX vaults are bleeding. The registered silver, the metal available for delivery, is disappearing faster than it can be replaced. We're watching a slow-motion bank run, but instead of people lining up for cash, we have entire industries lining up for metal. And the banks? The banks are discovering that you cannot print silver. You can print dollars to cover your losses. You can print euros and yen and yuan, but you cannot print the atomic structure of element 47. That's the wall they just hit at 417 this morning. The 34 billion is just the down payment. It's the entry fee to stay in the game. But every day that Shanghai trades above New York, every day that gap exists, the bleeding gets worse. Think about the mathematics of leverage. These banks don't just own silver. They own contracts representing millions of ounces. When the price moves $14 against them in a single session, the losses aren't measured in thousands. They're measured in hundreds of millions. But this isn't just about money. This is about something much more fundamental. This is about the death of paper promises. For decades, the banking system has operated on a simple principle. We sell you paper contracts. If you ever want the real thing, we'll figure it out later. Later just arrived. The industrial demand isn't theoretical anymore. It isn't speculative. Solar panel production has tripled. Electric vehicle manufacturing is exploding. Every smartphone, every computer, every piece of modern technology needs silver. And for the first time in history, the demand is outstripping the supply by margins that can't be hidden with accounting tricks. The Shanghai price is telling you something. It's telling you that in the real world, where factories actually need metal to build things, silver is worth $85. The New York price is telling you something else. It's telling you that in the paper world, where banks trade promises, they're still pretending it's worth 71. But the paper world is collapsing into the real world. And the Federal Reserve just spent $34 billion to slow down the collapse. They didn't stop it. They can't stop it. They just bought time. Expensive time. Time that comes at the cost of dollar credibility. Time that comes at the cost of monetary stability. The gap between 85 and 71 isn't just a price differential. It's a measure of how divorced the financial system has become from physical reality. It's a measure of how much paper has been printed against how much metal actually exists. And every day that gap persists, every day the arbitrage stays broken, the pressure builds. Like water behind a dam, like steam in a boiler. Something has to give. The question isn't whether the system will break. The system already broke at 417 this morning when the Fed had to create $34 billion out of nothing to keep it functioning. The question is what breaks next? Because $34 billion won't be enough. Not when silver is trading at 90 in Shanghai tomorrow. Not when the industrial panic spreads to London. Not when the European markets wake up and see what happened overnight. The Fed has opened a door they can't close. They've admitted that the banking system is fragile. They've admitted that a $14 move in silver can threaten the entire structure. They've shown their hand, and the market is calling their bluff. Every central bank on the planet is watching this. The Bank of Japan, the European Central Bank, the People's Bank of China. They're all asking the same question. If the Federal Reserve has to print $34 billion to handle a silver crisis, what does that tell us about the stability of the dollar? What does that tell us about the stability of the system that props up the dollar? But here's what should terrify you about the geopolitical implications. This isn't happening in isolation. 3 weeks ago, Russia announced they were stockpiling precious metals as part of their strategic reserves. 2 weeks ago, India's central bank quietly purchased their largest silver allocation in over a decade. Last week, Saudi Arabia began accepting yuan for oil payments. The timing is not coincidental. These countries see what's happening in the silver market and they understand what it means. They understand that when the Federal Reserve has to print money to prevent a commodity squeeze, the entire dollar-based system is in jeopardy. China isn't just buying silver at $85 because they need it for manufacturing. They're buying it at $85 because they want to break the Western price control mechanism. Every ounce they purchase at a premium is a vote against the paper-based price discovery system that has kept commodities artificially cheap for decades. This is financial warfare disguised as market activity. And the Federal Reserve just signaled that they're losing. The $34 billion injection tells every rival power on Earth that America's financial system can be brought to its knees by a $14 move in a single commodity. What happens when they coordinate? What happens when Russia corners palladium, while China corners silver and India corners nickel? The answer is what you're witnessing right now. Systematic destruction of Western financial hegemony, one commodity at a time. But let me tell you what's happening behind closed doors right now. Emergency meetings, crisis calls between central bank governors, urgent diplomatic cables flying between Washington, London, and Brussels. The Bank of England called the Federal Reserve at 5 a.m. London time, not for a scheduled consultation, for an emergency briefing. They wanted to know how bad the situation really was. They wanted to know if London's precious metals market was about to face the same crisis that just hit New York. The European Central Bank convened an unscheduled meeting. No public announcement, no press release. Just senior officials gathering in Frankfurt to discuss what they're calling a strategic commodity security issue. These institutions don't panic easily. They've weathered every financial crisis of the last 50 years. But they've never faced anything like this. They've never confronted a situation where their ability to control markets through paper manipulation has been so completely exposed as inadequate. Because here's what they're all realizing in those emergency meetings. The silver shortage isn't just about silver. It's a template. It's a proof of concept. It shows exactly how to break Western financial control over global commodity pricing. The answer is becoming clearer every hour. The system is running on fumes. The system is held together by the promise that central banks can print their way out of any crisis. But you can't print commodities. You can't print energy. You can't print food. And you definitely can't print silver. The $34 billion injection is the admission that the paper economy has lost control of the real economy. The tail can no longer wag the dog. The derivative cannot control the underlying asset. So here's what you're witnessing. You're witnessing the moment when the financial system realizes that physics trumps finance, that geology trumps monetary policy, that the periodic table doesn't care about interest rates. The Federal Reserve can print dollars faster than anyone can count them. But silver is formed in the hearts of dying stars, and there's only so much of it on this planet. The gap between Shanghai and New York will close. It has to close. But it won't close because Shanghai comes down. It will close because New York goes up. The paper price will be forced to acknowledge the physical reality. $34 billion is just the beginning. Watch what happens when silver hits 90 in Asia tomorrow. Watch what happens when the London markets open and see this chaos. Watch what happens when the pension funds and sovereign wealth funds realize that the Federal Reserve is monetizing commodity manipulation. But let me give you the specific timeline for what's coming next. Tomorrow morning, when London opens, they're going to see the Shanghai-New York spread, and they're going to panic. European industrial buyers are going to flood the market. The premium gap is going to widen from $14 to $20, maybe $25. By Thursday, when the full institutional money returns from the holiday break, they're going to walk into a market that's completely disconnected from reality. Hedge funds are going to see silver trading at 95 in Asia and 75 in New York, and they're going to try to arbitrage it. But they can't get the metal. The vaults are empty. By Friday, we could be looking at silver trading at different prices on every continent. Asia at $100, Europe at 90, North America still pretending it's worth 75. The global price discovery mechanism will be completely shattered. And every day this continues, every day the Fed has to inject more billions to keep the banking system alive, the dollar loses more credibility. More countries abandon it. More central banks dump their treasury holdings. The game is changing. The rules are changing. The very foundation of how prices are set in global markets is shifting beneath our feet. And it all started at 4:17 a.m. with a $34 billion emergency injection that the mainstream media will barely mention. They don't want you to connect the dots. They don't want you to understand what that money printing means for every dollar in your bank account. They don't want you to realize that the bridge between the paper world and the real world just collapsed. But the silver market doesn't lie. $85 in Shanghai, $71 in New York, $34 billion from the Fed. The math is brutal. The implications are terrifying, and this is just the first domino. The next domino falls when the London Bullion Market Association admits they can't source metal for physical delivery. The domino after that falls when the COMEX declares force majeure. The final domino falls when the entire paper-based commodity system collapses and prices reset to levels that reflect physical reality rather than financial manipulation. We're not just watching the silver market break. We're watching the death of the post-Bretton Woods monetary system. We're watching the end of the era where central banks could control commodity prices with paper contracts and unlimited printing. And here's the most terrifying part. The people running this system know it's breaking. The 34 billion injection wasn't just a rescue operation, it was an admission. An admission that they've lost control. In the old system, when silver spiked, they would just create more paper contracts, flood the market with shorts, drive the price back down, but you can't short something that doesn't exist. You can't manipulate a market where the physical commodity has disappeared. The Western central banks spent decades convincing the world that paper was as good as metal, that promises were as good as delivery, that derivatives were as good as the underlying asset. Shanghai just called their bluff, and the bluff was worth $34 billion to defend. But defending a lie gets more expensive every day. Tomorrow it might cost $50 billion. Next week, $100 billion. Eventually, the cost of maintaining the illusion becomes larger than the entire money supply. That's when systems collapse. Not gradually, not with warning. Instantly, completely, permanently. Something much bigger is coming, and when it arrives, the gap between paper promises and physical reality will look like a hairline crack compared to the chasm that's about to open. The 34 billion was the Fed's white flag. They just admitted they can't control this anymore. They can't suppress reality with paper. They can't print their way out of a physical shortage. The age of honest pricing is coming. And for those who understand what that means, for those who can see past the propaganda and the manipulation, the greatest wealth transfer in human history is just beginning.